Hi, Ron LeGrand here. Before we get started with the podcast, I thought you might want to know that I recently recorded a 90-minute online training about how we make so much money today in the terms business. That's on pretty houses in pretty neighborhoods, not the junk houses that we have to go rehab or wholesale. I go through step by step on exactly what I and thousands of my students are doing right now to make the fastest and the easiest money in real estate without using your money or credit. If you're interested in doing just that, go to thementorpodcast.com/free training. See you there.
Welcome to the Mentor Podcast, where the most highly motivated entrepreneurs come to get their weekly dose of financial stability with host Ron LeGrand, as well as other nationally recognized thought leaders who will teach you how to get, grow, and protect your wealth.
Hello, everybody. Welcome to another edition of thementorpodcast.com. I've got a very special guest today. His name is Josh Cantwell. And if you're interested in apartments, you're going to want to listen to this guy. And if you're not interested in apartments, you're going to want to listen to this guy. Josh has over 4,000 units. He's also a cancer survivor, so I want to get that in today as well. Josh, welcome to the show, sir.
Hey, Ron. Thanks so much for having me on. I appreciate the invite, and I'm excited to share.
Okay. I probably don't know anybody that knows more about you than you, so why don't you give us a little bit of your background and where you're at today?
Sure. Absolutely, Ron. Like a lot of guys, I started investing in single-family homes. I was actually, when I graduated from college, I had got my Series 6, my 66, 63. I became a financial advisor, 24 years old. I thought I knew about how to advise other people and their finances when I was 24. But I hustled my face off. I worked really hard. Most of my clients were 2-3 times my age and was making a great 6-figure income in my very young, early 20s. And but what I recognized and noticed was a lot of my most successful clients did not have their money in the stock market. They had their money in real estate. They owned buildings. They leased them out to restaurants. They owned apartments. They owned single-family homes. So I took notice. And in 2001, just 3 years after I graduated, I bought my first duplex. Matter of fact, that duplex is actually scheduled to finally sell in about 2 weeks. I'll finally sell my first investment property ever. Long story short, we were investing in, Ron, we invested in primarily in wholesaling and specifically in short sales and pre-foreclosures. The reason for that is because I'm from Cleveland, Ohio, and there was 10 large, big Fortune 500 companies that left town in the early 2000s. So there were a lot of people already facing foreclosure before the main foreclosure crisis that everybody knows of 2007, 8, 9. We did that for about 10 years. We're super successful at it. We became a nationally recognized speaker. Then I was diagnosed with pancreatic cancer. We can get into that. That changed everything about what I do to really focus on, much like you, Ron, you focus on terms. I like to focus on buying buildings with the right capital stack and raising and recruiting private money. I realized that when I was, fighting cancer, I didn't have any income coming in because I wasn't wholesaling anymore. I wasn't doing short sales anymore. And so that completely changed the trajectory of my investments. And today, that's led to us owning and running a private equity fund, and then us owning and running all of our apartment buildings and complexes that we own today. But it all started years ago with that very first duplex.
So I think you just said that you learned that residual income was way more important than that next check.
Oh, man, did I ever, Ron? I learned a very painful lesson when I was diagnosed. Because so imagine, Ron, I'm 35 years old. I'm at work doing my thing, wholesaling and teaching and doing deals. We have a whole business built around it. We have software built around it, but it was all very transactional. And I came home from work one day, like a lot of 35-year-olds. My wife was 8 months pregnant. I had a 2-year-old and a 1-year-old. And I laid down and I rest my hands across my stomach. I was playing with my girls on the floor. I looked up at the ceiling fan and I felt this giant lump on the left side of my stomach. And I thought, oh crap, that can't be good. I'd mentioned to my wife, like, this feels really weird. Like, it's in a weird place. Like, what do you think? A buddy of mine's an orthopedic surgeon, lives across the street. I go over to him. His name is Latul. I say, hey, Latul, check this out. He's like, yeah, that's not a hernia, man. That's in a weird spot. Go get a CT scan. And within 2 weeks, I was diagnosed with pancreatic cancer, and my world was completely thrown into upheaval overnight. So nobody would expect that, right? So nobody's really thinking about residual income when you're 35 and you're healthy and you think you can just run through a brick wall. But for me, like a lot of other people, you get the worst news exactly when you're not expecting it. And so at that point, I was like, wow, okay, I've got a pretty big fight on my hands, not just for my business, but for my actual life. And for the next really 9 months, I really couldn't work very much. I took the next 6 months out of the next 9 months away from the business. I was doing testing. I was getting treatment. I had a major surgery, recovery, and I was not able to work. And all of a sudden, I realized what I had done wrong. I realized what I had done wrong in my real estate business. Although it paid me well, it did not have residual income. The lesson I learned, though, Ron, when fighting cancer is that I had purchased and bought a couple of properties that I planned on buying, rehabbing, and either flipping or renting. And I had done that with private capital. I did it with private money, not a bank financing, not through, some institutional finance or some corporate lender, through a true mom and pop private lender from their self-directed IRA. And I was able to control that deal by controlling the money. I was able to control the deal by controlling the terms, just like you teach. I was able to control the deal by controlling the capital stack. And then we were able to outsource the improvements, improve the property, and ultimately we decided to flip it and sell it, frankly, Ron, because I needed the money because I hadn't been working for 6 to 9 months. So we sold those properties, but I thought in my head, that was when I realized, that was the epiphany, when I realized, the first 6 or 7 years of my investing career was great. I learned a lot, but now I needed to focus on controlling the capital, whether it was buying on terms, whether it was private money, whether it was creating a private equity fund. And the money, owning the asset, allowed me to create that residual income. And so I tell my audiences today, Ron, funding equals freedom, because funding is what creates that residual income.
Yeah. Now, you got a lot of apartments. So I want to first ask you, how does a guy get to the point where they have 4,000 apartments?
Yeah, great question. So it started, Ron, we had a private equity. Here's the evolution, right? And I think this will relate to a lot of your audience. I was a single family investor. Now it's post-surgery, and I was controlling the capital. I was buying a lot of rental properties, doing some flips. I had so much private money because I focused on raising private capital as my number one objective. Was not finding deals, but it was finding the money from true private investors, the mom and pops who could fund, $100,000 deals, $500,000 deals, $50,000 deals. And what happened was we raised so much private money that I didn't want to just keep buying single family homes or keep doing flips. We decided to aggregate that money into a private equity fund. We hired a securities attorney. We did it, and we became essentially a private money lender and hard money lender. So we lent the money out to create passive income in the fund, and we got some of that passive income as the fund manager. So we got this passive income coming in. Now, what happens with apartments is about 4 or 5 years ago, my investors that were in the fund said, Josh, this is great. We're getting a great return. We love it. But what else do you have? And we had already been lending on commercial real estate as a private money and hard money lender out of our fund. We lent on a number of apartment buildings. And so we went back to those guys and said, look, help me understand your apartment deals. Like, I get it from a lender's perspective. We've already funded some, but help me understand the equity. Help me understand, where's you getting your equity from? Where are you getting your money for capital improvements? Where are you getting your money for your down payments and your earnest money deposits? And I learned about that. And I thought, okay. So I had 2 buddies that were really heavy into apartments, and I started joint venturing with them, co-sponsoring deals with them, co-syndicating those deals, helping them. And in some of those deals, we had to personally sign for the debt. I know that's against your rules, Ron, I know, but we broke the rule. We had to sign for some of the debt. We got a bunch of equity. So we did some JV partnership deals. Over time, we then created our own business here in Northeast Ohio, where we focus on apartments in Cleveland, Akron, Canton, Columbus, and Cincinnati. And we built up a big portfolio of the properties that we no longer JV on, but we are the owner, operator, and sponsor. So it's been an evolution really for the last 10 years.
So give me an example of the structure of the financing on a normal apartment deal.
Yeah, for sure. So I'll give you an example. I'll give you a small deal, and then I'll give you one that we actually we're waiting to hear back on today of the offer. So we found a deal through a wholesaler. It was in Lakewood, Ohio, in the Gold Coast. Purchase price of $2.7 million plus a $300,000 wholesale fee to a wholesaler. So all in for $3 million. We're going to put about $250,000 in improvements into the building, mostly in the units, upgrading the units, remodeling the units, plus adding a courtyard. The building's sort of U-shaped, so there's a courtyard in the middle. We're going to upgrade the courtyard. And we're going to have really modern units. So then we're going to bump all the rents. So the property pencils out based on about a 6 cap at about $5.2 million once we hit stabilization. So we bought it at a discount. We bought it from a guy who had owned the building for years. And this is one of the motivations, Ron, that you'll understand. Hopefully your audience will understand. We like to target sellers that are at the end of their depreciation schedule because they need to begin selling the building because there's no depreciation left, or they know that in the next couple of years, they're going to start paying taxes. And so we like to target owners that have owned these buildings for roughly 25 years. And typically these guys are in their 70s and 80s, and they've owned the building a long time. And they have, no more motivation to really improve the building. So the building hasn't been improved for 5 to 10 years. And so we buy the property at a discount so they can exit. They'll often do a 1031 exchange, or they'll do something to shelter some of those taxes that they're going to have to pay. But that's the way we get deals at a discount. We love those deals working with sellers where they're between 30 units to about 80 to 100 units. When you're in that mom and pop price range, mom and pop unit size, there's really not a lot of brokers involved. So we bought that building for $3 million. It's going to be worth 5.2. We'll be all in for about 3.4, 3.5 when we're done with some soft costs and fees. Now, the way we funded that deal, the way we had to structure it, we had to, on that deal, the seller did not want to carry back the financing. We asked him if he would. He was not interested in that. So we had to get a bridge loan, and we did have to personally guarantee it because the building was it was only 80% occupied. So we could not qualify for any permanent non-recourse financing up front. But
stop. For the sake of our listeners who are trying to keep up,
yeah,
the whole reason you bought it was because it had a problem.
That's right.
Vacancy, and it needed some work. And that's the reason you got the deal that you got. Because if that weren't the case, you'd wind up having to pay retail price for it. So
that's right.
To buy it, some kind of problem fixed, and you fix the problem. Now, when you fix the problem, you got to decide whether you want to keep it or whether you want to refinance it, or keep it, or you want to sell it. And the reason you couldn't refinance it is because the vacancy rate was so large that a lender would not approve the loan. Right.
Right. That's correct.
You said you got some interim financing. What kind of financing?
So the financing was bridge. It was through Lima One was the lender, and the remaining capital that we received. So we're all in for 3.4. The finance we got from Lima was 2.4, which included some rehab draw dollars, and the other $1 million we syndicated. We raised that money from private investors that came in. The minimum investment on that deal was $100,000 a unit. Some people that came in for $200,000, $400,000. But we syndicated the rest. So I was able to do the deal with none of my own money. We even had a private lender that funded the Earnest money deposit that was willing to do a promissory note for the Earnest money. And then we ultimately closed, and then that Earnest money converted into equity. So I was able to do the deal with none of our own money, but we did have to sign for some of the debt personally.
But it was a short-term debt, and the whole goal was to get the thing turned around and refinance it with non-recourse debt, or to sell it.
That's exactly right. No, we're a long-term holder, Ron. We like to hold our debt or hold our assets long-term. So the goal is to stabilize the building, push the value up through obviously remodeling the units and raising the rent, and then refi and hold. So at a $5.2 million valuation and a 75% new loan, a new permanent loan that we'll put on the building roughly 2 years from now, we'll be able to cash out about $500,000 of cash out tax-free refi proceeds. So that's $500,000 in our pocket with no tax because it's loan proceeds. And then we'll hold that building, and it will cash flow about $120,000 a year of net free spendable cash flow after all the expenses and after all the debt service. So it's going to take us about 2 years to stabilize the building. Could do it a lot faster, but the way the structure is now, it works for the next 2 years. And we know rents are going up. We know there's some inflation. And so we like to hold those assets even a little bit longer if we can, because we know the market's going to take that building for a ride.
So is that pretty much the way you buy all your buildings?
Yes.
From private investors and then some borrowed money below?
Absolutely. Now, of course, the larger buildings, like the 360 unit that we just offered on Wednesday, we offered $19 million for that. It's about $52 a door, $52,000 per door. So big deal. But that building hasn't been dramatically improved or remodeled for at least 5 to 10 years. Everything in the building is laminate, countertops, laminate flooring, brown carpet, brown cabinets, very boring. The rents are under market value by about $75 as the building sits today. So we should be able to just raise the rent $75 without doing anything. But if we do a value add improvement program where we're going to modernize the units, which is our main plan, we should be able to bump those at least $150. That will take the value, as we know, commercial real estate is valued off of the income. That will take the value up closer to 27 to 28 million by the time we're done with it. And we have a 3.5-year time horizon on that deal. So that one, the financing structure is very similar. However, because this building is 94% occupied, we can get permanent non-recourse financing from Fannie Mae, Freddie Mac, or a CMBS loan, a commercial mortgage-backed security loan. We can get that right from day one. And that's the plan. Because with the economy, Ron, as you know, the way it is today, there's definitely uncertainty of what's going to happen over the next year or two. So I don't want to sign for, I want to sign for as little debt as I can. So we like to buy buildings that have a 90% occupancy because we can get non-recourse. Yeah. So although we can get a bridge loan for this deal, we can get a hybrid loan, we can get lots of different types of funding, we'd rather have that permanent loan non-recourse. Because using your rules, Ron, again, we don't want to sign for anything. We don't want to be personally liable. So
you're going to add the repair money into the purchase cost, and you're going to borrow 90% of the total of the two?
Well, on a permanent loan with Fannie Freddie, with non-recourse, they're only going to fund about 75 to 80% of the purchase price. Okay. So that 19 million, and then we'll have to raise the remaining down payment. And we'll have to raise the capital improvement money as well. I could get higher financing, like let's say 80% through a bridge loan. Well, they'll fund 80% of the purchase and the renovations. However, again, using your rules, Ron, we don't want to personally guarantee that, and they would require a personal guarantee on a bridge. So we want to go in non-recourse, not personally sign for it. That's just going to require us to raise a little bit of extra private money.
Yeah. And then your goal is still to refinance it when you get it turned around with a permanent loan. And actually you can get, if I'm not mistaken, about 90% on a stabilized unit. Is that not?
That's correct. Now in our area in the Midwest, it might be more like 80. In the South, especially the Sun Belt, Florida, Texas, Arizona, the lenders are definitely going up higher to 85 to 90% on stabilized because they see the population migration. They see the rent rates going up. They see those areas appreciating. We like the Midwest because one, there's less people playing in the Midwest. And also there's not as much institutional buyers in the Midwest, but also it's just a cash flow market. Like I'm not speculating on appreciation here. I'm buying at a discount on day one.
One thing I don't like about where you're at, and that's the winter temperatures.
Right. That's why you live in Florida. I get it. I go to Florida a lot. We love it, but the winter is brutal. Now, one of the reasons why I'm here, Ron, is my girls are, they play club volleyball, and club volleyball is a winter sport. So I have to stay so my girls can play sports.
All right. So Josh, let's back up a little bit.
Mm-hmm.
Back when you were starting in the apartment business, because I know our listeners are asking, well, golly, how do you go about getting all this private money you're talking about? That seems like an awful lot of space.
Yeah, I think first of all, the first thing I would say is raising and recruiting private money for me is my passion. It is my number one objective. So I've always since my surgery, told myself that funding equaled freedom. So if I could get the funding, the private money, I could get deals that other guys couldn't get. Guys might make an offer on a single family home or a commercial home, but if they can't close the deal, the deal doesn't really matter. And if you have capital, you can attract additional deals. Like we attract student partner deals. I attract deals from brokers. I attract deals from friends and family. We attract deals from wholesalers because they know we can close. So instead of going and finding the deal first, my passion became find the money first. So that's what I would start with our audience and say, if you want to be a really prolific real estate investor, whether it's on the resi side or commercial, you've got to understand private money. So you can marry up private money with, a seller who's selling on terms, or you can marry up private money with a bank loan, or you can marry up private money with a bridge loan. So that's the first thing is where's your focus? Where's your brain at? Mine's on the private money. That's number one.
Well, on the other hand, there's the guy who made almost $300,000 flipping the thing to you.
Sure.
So what did he do? He made an offer, he put it under contract, and then he found you.
That's right.
So there's plenty of ways to make money there. Now, of course, you're going to make many, many, many times what he made, but of course, you're going to earn it. All right.
Mm-hmm.
Do you have any idea how much of an earnest money deposit he put down to tie up that property?
That earnest money deposit it's usually about 10% of the purchase price. So somewhere around $25,000 to $30,000.
Okay. So that was a risk that he took. Do you know how long he had to close on that deal?
He had almost 6 months. I mean, he worked with the seller and he was able to negotiate with the seller, talk with the seller. And one of the interesting things about this deal, Ron, was there was actually a fire at the building a year ago. So there was a fire in it's a 4-story building, a mid-rise apartment. There was a fire in unit 401 and there was water damage in all the units below it. So unit 301, unit 201, unit 101, plus there was smoke damage. So my buddy Adam, who was the wholesaler, Adam got it under contract, but knew, and he was smart enough to know, he was going to execute the contract, get it under contract, but basically say, I can't close until all your renovations are done and you get a certificate of occupancy from the city. So he bought himself months and months and months of time to be able to wholesale that deal. So again, he had a problem with the seller. The seller had a fire. The seller was older. Seller was running out of their depreciation schedule. So multiple layers of motivation. Adam was able to get that deal under contract, $25,000, knowing, hey, I've got plenty of time now. So there's very little risk here. And I don't even have to close until after the seller gets the certificate of occupancy. So he almost had an unlimited window of time.
That period of time is not abnormal at all, even if it didn't have the fire.
Right.
So, did he know you when he put it under contract?
Adam did not know us. We ended up doing another apartment that we bought from Adam between the time he got this larger deal under contract. About 3 months after that, we bought a different apartment building that Adam also wholesaled us. We paid him $92,000 on that one. And then 3 or 4 months after that, we ended up closing on this 52 unit.
How did he find you?
We're pretty prolific with our social media. We have our own podcasts. We're very active on Facebook, Instagram. We're very active on LinkedIn. And Adam is a local wholesaler. He had heard about us through some real estate investment association meetings, followed some of our stuff on social media.
Gotcha. You and I are a member of the same mastermind group, Family Reunion.
You bet.
I wonder if he was in that, because that's
he was not.
Meet other people. All right. So I'm looking at this from Adam's point of view. It took a lot of guts on his part to put up $25,000. Incidentally, I bought buildings that size with a whole lot less deposit.
Sure.
I need the 25, probably because that's what he offered. But it took a lot of guts on his part. That's all he needed was guts and a little bit of money.
Yeah. I think he was so confident, Ron, in the deal, knowing the location, knowing that he was getting it under contract far below market value, knowing that the seller was motivated to sell. And then if he didn't get it under contract or offer some sort of, in this case, some sort of earnest money, the seller was actually a real estate attorney. So the guy was fairly, fairly experienced, knew the language, was expecting an earnest money deposit. But Adam got it under a contract so cheaply, there was little or no risk there at all.
Yeah, I would imagine so. Okay. So let me ask you, what's the most important piece of advice you could give our listeners from your vast experience today?
I would say, listen, two things. Funding equals freedom. If you want to be free from this business or any other business, you've got to be well capitalized. That capital can come from seller financing. It can come from private investors. It can come in some cases from bank financing. But again, like Ron teaches, focus on the non-recourse funding. To me, we're able to have a lot of deal flow coming to us because people know we can close and we have access to a lot of capital. That's number one. Second piece of advice, Ron, is this is a very personal piece of advice. And I can tell you, going back to my cancer experience, about 6 weeks after my surgery, I was sitting with my oncologist, and my oncologist read the report of everything that was done to me. And not to get too detailed, but the surgery that they did was very dramatic. There was many doctors that I was told, would never have even tried the surgery that they tried. My oncologist looked at me and said, Josh, your surgeon, Dr. Walsh, is a daring surgeon. And I looked at him and I said, well, what do you mean he was daring surgeon? He said, Josh, look, I'm looking at this report. I've never seen anything like this. I've been in this business for 30 years. And Dr. Walsh did a surgery that most surgeons would have never even tried. He was a daring surgeon. And so I tell my audiences today, look, if you want to change the world, or you want to change your life, your financial life, the life of your kids, grandkids, spouse, you're going to have to step out and be daring. You're going to have to try things and do things that other people won't try. You'll have to listen to the naysayers and what they have to say and brush it off and be daring and go pursue the life that you want. And it's going to require you taking some chances. It's going to require you taking some risk. That's what Dr. Walsh did when he performed my surgery. I wouldn't be here today if Dr. Walsh wasn't daring that day, November 21st, 2011, the day of my surgery, if he wasn't daring. And Dr. Walsh prepared himself for surgeries like that. He did the research. He had a mentor. He went through education, schooling, so that when he came across this opportunity to have a life-changing surgery for someone like me, that he was ready to do that. So how do you parlay that into business, right?
Your surgery at Johns Hopkins?
My surgery was at the Cleveland Clinic. Which is one of the top 4 hospitals in the country. Yeah.
Dr. Walsh take out my prostate. I wonder if it's the same guy.
Yeah. Probably a different guy.
That guy followed up with me for 10 years. 10 years. He kept writing me letters and see what my test came out to be. So I've never seen a doctor like that. Anyway, all right. So you're cancer free now?
I sure am. It's actually going to be 10 years this November. And to put that in perspective, Ron, pancreatic cancer has an 8% survival rate, right? 8. So, and that's after 5 years. I'm coming up on my 10-year anniversary, and it was all because Dr. Walsh took a shot. He was daring. He took a chance when a lot of other doctors wouldn't have done it. So how do we use that in the real world or in the business world or our personal lives? It's that ultimately the people who are educated, people that have mentors, people who are self-studying, that are working hard, that are listening, that are going through training, and then ultimately they're given an opportunity, like a real estate opportunity. They're there and ready to execute on it. That's what Dr. Walsh did on the operating table. That's what you've got to be ready to do in business.
All right. So listen, I know that you actually take on students from time to time and mentor them. So tell us how we can get some information about that.
Absolutely. So Ron was gracious enough to set up a little bit of a website. It's thementorpodcast.com/Josh. There you can go. You can watch a little video of a bunch of my apartments. You can see me on site at my apartment buildings. We only run a very high-end coaching, mastermind, and partnering program. We do student partner deals similar to you, but we only do apartment deals with our students. And so if some of your audience is interested in apartments, maybe needs a partner who's got a big balance sheet, who's got the ability to raise capital, and wants to learn and get coached, they can go to thementorpodcast.com/Josh, and they can apply to be in that program on that site.
Good. I think most of my listeners know that I also teach a commercial boot camp. It's a 3-day event. And in fact, I got one coming up in October if they watch this early enough. So check on that with my team at the office because we got a special deal working for you as well. Josh, you are a world of information here for us. And I'm telling you, an inspiration for folks who want to get in the apartment business. And I appreciate you taking the time out of your schedule. Looks like you're at home too, am I right?
I sure am. I'm in my home office, which is my favorite place to operate.
Yeah, well, I'm getting a little tired of being around here. If you want to know the truth, I'd like to get out of here more. We're doing a few live events now, but nothing like we used to do.
Sure.
Anyway, thank you for being with us today, sir.
Absolutely, Ron. Thanks so much for having me on the show.
That's all for this edition of the Mentor Podcast. To connect with Ron and learn how you can attain financial freedom, as well as up-to-date strategies to grow and protect your wealth based on today's discussion, go to www.connectwiththementor.com.